Hi, it's Travis Adams here with a reporting season update. Global mining giant Rio Tinto announced a 40% fall in underlying earnings to $9.3 billion for 2012. Rio posted a statutory $3 billion loss after impairments of $14.4 billion relating to its aluminium business and coal assets in Mozambique. Cost pressures also helped to reduce the underlying result, but the result was also in line with analyst expectations. The company actually increased full year dividends to $1.67 US a share, up 15% on the previous year, which bolstered analyst confidence. Overall, the result was impacted by lower commodity prices, as they fell from record highs in 2011 for nearly all of Rio's major commodities. Volume increases, however, were mainly due to iron ore, where sales rose 3% due to increased capacity at their Pilbara and Escondida operations. Sam Walsh also became the CEO in January 2013, and the recent write-downs can be considered a clearing of the deck strategy as Rio tries to move on from the disastrous Alcan acquisitions under former CEO Anthony Albanese. Wesfarmers announced a 9.3% rise in half-year profit to $1.2 billion. Earnings per share were up 9.2%, and half-year dividends were increased by 10% to 77 cents fully franked per share. Wesfarmers said the strong retail earnings growth during the half in Coles, Bunnings and Kmart contributed to the result. Coles delivered earnings growth of 15.1%, while the return on capital for that division increased by 100 basis points to 9.2%, which is a much better outcome than in the past, with the return on capital being closer to 5%. A 9.2% result is much better, and we really look forward to further improvement in this number. Bunnings recorded a 6.8% year-on-year rise in earnings to $518 million, with sales increasing across key product categories and trading regions. The CEO stated that Wesfarmers expects growth from the group's retail business as they further improve customer offers, operating efficiencies and strengthening all of our channels to the market. Telstra also reported their results, which was an 8.8% increase in net profit for the first half to $1.6 billion. The company also declared a dividend of 14 cents per share, which is in line with expectations of 28 cents per share for the full year. Telstra's earnings really have continued to be flat for a very long period of time now, and this is against an increasing share price. We really caution against buying just purely for yield, which appears to be what the rest of the market is doing. Earnings need to be increasing over time to ensure that you get an increasing dividend. Telstra's dividend has also been flat for almost 5 years now, and we expect this to continue at least for the next 2 years. We would really like to see some increase in earnings. Most of the other stocks that we have on our list have continued to have increasing earnings over time, and because of that, increasing dividends. Telstra, while its yield has been great when its share price was lower, has seen its share price rise up quite significantly over the past year, and we really caution against buying it at these levels. A company that disappointed the market was Cochlear in announcing their 3% fall in net profit for the first half to 31st of December 2012. Implant sales rose 27% to 13,500 units for the half, while total revenue only rose 1% to $391 million. The Cochlear's chief executive, Chris Roberts, described the result as pleasing, as he said the rising Cochlear implant numbers confirmed the company's market leadership position despite the recent recall. But the company did not provide any specific earnings guidance for 2013. Cochlear declared a dividend of $1.25 per share, which was 40% franked and up 4% on the same half last year. And we really are expecting better results from Cochlear. The market expected them as well and punished the share price by more than 10%. after the result. If you would like more information on any of this, please contact one of our advisors at www.prescottsecurities.com.au.